but for me, like the residential stuff kind of like fell in my lap. So it's like, but I think from like a longer term perspective, it's probably not where you want to be.
Yeah, it depends. Like I'd say it's probably the most replaceable with like technology or automation. So like
100%.
A little bit of like long-term vulnerability there, but I don't know, like for guys like you and I, like that, the critical thinking is what protects you against automation, right? Like I don't think it's us that'll be replaced by a computer anytime soon.
No, for sure. I think that, but yeah, I do definitely feel like those commissions continue to like compress over time with technology and stuff. So
for sure.
should weed a whole bunch of people out of the business, and then I mean, I don't know. I feel like also at the same time is like people don't really. I think on the residential side, people don't necessarily appreciate as much of like the critical thinking, like analysis.
Right.
Most people, most of those buyers are just like they're like emotional, right? They just like they just want to like they just want to make sure they have like quartz countertops and stainless steel appliances. They don't really care if like it's a good time or a bad time or what I mean.
Yeah. Well, and for most of them, like they're thinking about it as a savings vehicle and a 5-year hold anyway, right? And in most cases, like by the time your mortgage is up for renewal, you're usually in the green, unless it's like the 90s, right? But so it's that you're right. It is funny though. Like, so how does that play into like, because you obviously have like a really, really good perspective on the economics of it. Like, do a lot of people come to you for that value with residential product?
I think like definitely like quite a few of them do. I think a lot of it too is just like they might not be like as economically or financially sophisticated, but like a lot of them, they're just like, oh, I just need someone that like knows what he's talking about that I can trust.
Yeah.
And so a lot of that, it's more so like, okay, like I'm gonna drop $1.5 million on a house. Like, who do I trust to like help me make this decision? And so that's usually what it is. And then obviously like a lot of my clients are more interested in like finance and economics, so there's kind of like a natural syndication there.
I guess it also like it just removes that they don't have to, I guess, run that function in their brain in the process, right? So like they can just kind of like be at peace with that piece, knowing that they're in good hands and they can focus on the product, right?
I think that most people just kind of want to be told what to do too, right?
Yeah, for sure.
Like what should I buy, and is this a good price and a good deal? What do you think? So that's basically what it is.
Have things slowed down a lot for you?
Right now it's really slow. It's not much. Like sales are down 50%, new listings are down like 65%. So I mean, I'm still like keeping busy with like talking to clients and content and all that stuff, but in terms of like going out and like actively like selling places, it's slow.
I did my first showing in like a week and a half today, like earlier at noon, and it was a vacant commercial piece, so we just kind of like chilled. We still had to mask up and everything. It was interesting.
I'm kind of curious to see how that market does over there, because you guys are like, I think you guys are like frothier than Vancouver.
Yeah, it was extremely frothy. Like Vancouver, you guys you had some impact, right? Toronto, it was like the foreign home ownership tax came in and it kind of like leveled the single family detached market, which was just like that whole thing was obscenely overvalued. And then, but I guess, I don't know if CMHC policy was like designed to try and push all of the volume into the bottom of the market to try and like create price floor growth or what, but it seemed like basically all of the volume just got ported down below, like, let's say 600K. And that's why condos just went nuts. And like a lot of these sub-markets, like Georgina, Newmarket, where I, did the majority of my transactions at that time in like 2017, they just exploded and they're back up now. Like it literally looks exactly like that bull trap graph, right?
Yeah. That's kind of like same thing here. It's like the condos were like ripping hot. Like anything that's like in an affordable range was like ripping hot prior to the virus. And then, now it's kind of like frozen up. And I think I'm seeing some discounting and stuff. So it's definitely starting to happen.
Where does the discounting seem to be like appearing? Is it like distressed product, like kind of your, like,
I don't know, just people that need to get out, various product, like
yeah,
condos, houses. Like there's just obviously there's not really many bids right now. So
yeah.
And if you're on the market, like chances are you're probably fairly motivated. Otherwise, why would you have it on the market?
Yeah, for sure. Yeah, it's a good little selection bias there. Like a lot of buyers that I've had that, like, I think you get a lot of these like people who were marginalized out of the market maybe like 2 years ago and thought they'd never own a house are already entering the market. Like I think like the opportunity, like you've kind of like bounced off that opportunism, but then like I don't know, I'm still really reluctant, especially like on the housing side, to sell somebody like a home at least within the next like month. I think we need to kind of see like a concrete direction from this thing.
Yeah, no, I agree, man. It's yeah, it's gonna be. I don't know. I'm not that optimistic, but
No, I'm the same. I already had the recording going, but I'll probably just start it.
Yeah, that's fine.
Now-ish. So I'm just gonna grab something, and then if you're cool to maybe just start off with an introduction. I'm
sure. Can you hear me? Okay.
Yeah, man, it's perfect.
Okay.
Yeah. Yeah. So just for the people that don't know you, although I'm imagining probably more of the viewers for this are going to be coming from your audience than mine. If you could just do a quick introduction and go from there.
Yeah, for sure. Residential realtor in Vancouver, and then obviously do some advisory work as well with institutions, policymakers, some developers, and then just passion for economics and finance. So kind of tie all those in together and just try to keep on top of things in the markets.
Nice. The big thing that I've been talking to people about on these chats is just how things have changed, and I try and look at that sort of like on an individual level, and then like on a micro level, sort of in your market. Especially, I think it'd be nice to draw some comparisons between Van and Toronto. But also, I think you talk a lot about the macro, especially like through your content, and I think that's super insightful. How do you like apply that whole perspective to what's happening in your city and with the product, especially on the residential side? Because I think that's like where the majority of capital flows are right now.
Yeah, I think that like my view is like if you don't get the macro right, then the micro doesn't really matter. So it's like you kind of have to look at like the bigger picture and then kind of distill it downwards, and then you can kind of get into the micro. I think a lot of people that basically just they're so micro focused on like what's happening in like my neighborhood or my area or my city. But what they don't understand is like all the the policy changes, the credit changes, the economic changes. Like obviously when unemployment in Canada goes from, a 50-year low at 5% to what will probably be, who knows, anywhere from 15% to 20% to Alberta being, they're saying 25%. Like obviously that's going to matter for your housing market, because at the end of the day, it's like, if you don't have a job, you're not going to be buying a house. It's pretty simple. So, I think when you have a situation where, you can take, they're saying in Calgary, for example, an unemployment rate of 25%, like you have 1 out of 4 people not working. So that's a huge hit to demand.
Right.
And I think ultimately that the two biggest drivers, I think, for housing are credit availability. So mortgage rates, and then obviously employment as well. So that's kind of how I look at things.
Right.
And then from there, then you can distill it down, right? Like then you can go and look at the supply side of things. You can look at, months of inventory for sale. That's more of the micro, but you have to get the macro right first.
Right. On that note, then, like if you're talking about the unemployment, especially, I think, because I think that's the big looming variable that people are struggling to understand. Do you get the sense that like a lot of people are making the assumption that everything's just going to go back to normal in 3 months and that we'll return to like stable employment? They're all going to get like these layoffs will just be like all these companies will hire everyone back and the economy is just going to exist the way that it looked in February. Like, because that seems to be, at least sort of with your general consumer, that seems to be what a lot of people seem to think. And I fear that that's definitely not the case. Like, I think a lot of you're going to see some Darwinism with a lot of these businesses, and then a lot of the jobs go missing when those businesses start to collapse. What's your perspective? And that could be just a Toronto thing, but
no. Yeah, I think it's pretty real here. Like, I don't know. I work on like the retail residential side. So, I deal with clients, and obviously I talk to all my real estate realtor peers. Right. And I think the reality is, like, not to sound like a dick or anything, but the reality is that like most people, like let's call it 98% of people, probably generally speaking, don't really care or don't care to understand economics or finance. Most people just want to watch football and on Sundays and, have a kid, go out, drink some beers and not have to worry about things. Like it's just like economics and finance, like for one, it's extremely complex.
Yeah.
So it takes a lot of like self motivation, self desire. Like you have to have an interest in that subject to actually like sit through it all and actually try to learn like what all these complicated terms, how the banking system works.
Yeah.
I think there's like quotes back in the day where it's like, I can't remember who quoted it. It's from the 1930s, some famous guy, but it was like, the quote was like, if the average person knew how central banks worked and how money was created, there'd be riots on the street.
Right.
And so that's kind of how I view it, is that the reality is like it's just a complex system. And so most people are kind of in the belief that, I got laid off and, but I'm going to be rehired in, 2 or 3 months. I'll take my free check for now.
Yeah.
And yeah, I think that it's definitely naive. It's going to be a sad reality, I think, when people realize that, it's going to take a couple of years at least to get a lot of these jobs back.
Yeah. Yeah. No, I agree. I think it's sad. And I think it's especially sad. Like it adds the insult to injury that a lot of people don't realize that, right? Like I think everybody sort of, I guess that's sort of a method of control in the government's perspective that, that you don't want people to panic, but, and I guess that's like, it makes sense that they want people, that people are behaving the way that they want them to. But I really worry about like the general consumer, like a lot of the people that I know that are seeing this as an opportunity to enter the housing market and not understanding, like when people ask me if it's the right time to buy a house, I always say, would you be okay if it went down 20%? Because like everybody's buying it as if it is going to go up 20% in value, right? It's like, are you okay to weather that storm? Nobody ever asks themselves that question. That really concerns me. And I thought like earlier on in these discussions, I was saying, the best thing that I think people could learn from this is that economically we're not invincible, and personally we're not invincible. And that, when Dave Ramsey tells you to have a 3-month emergency fund or 6-month emergency fund, fucking do it. And companies need to do that too.
Yeah.
So that's a little worrisome.
It seems like that's like, to me, is like common sense, but like for most people it's not. But at the same time, you also like, let's call it what it is, like the government and central banks,
right,
policymakers basically have encouraged and incentivized every single person to take on a lot of leverage and a lot of debt.
Yeah.
That's been like the mantra. It's like, you don't need savings, just buy a house. It will just go up 10% every year. It's automatic, right? Like low interest rates. I mean, you can borrow a home equity line of credit at 3.5%. Like go out and go buy a car. And when you buy the car, buy it on a 7-year lease term it's a 7-year financing term. And you don't need to, if you want to buy a new couch and a new TV, don't worry, you can finance that too. Like, interest rates are cheap.
Yeah.
So it kind of just, it's unfortunate. It's kind of encouraged that. And obviously now, like, there's always an exogenous shock coming. We don't know what it's going to be. Obviously this one was like a virus.
Yeah.
Bad things happen every 8 to 10 years. We know that's just like systematic.
Right.
And unfortunately, when you have like this amount of debt, it just makes the recovery that much more difficult.
Right. Yeah. I think it's, for Canada, the worst possible timing for a black swan to enter. But I guess the reality is it probably would have only got worse had we kept going down it's not like things were showing signs of slowing on the consumer credit side. Like people weren't just magically becoming responsible, right? I don't think.
Yeah, and I think it's. I mean, obviously, like when you're in like a 10-year bull market, like we were, I think it was the longest bull market, in recent history. So, yeah, it just kind of creates like a sense of complacency,
for sure.
And complacency at like the sort of peak of the cycle, and then you get hit with like a exogenous shock. To me, is like the timing is just horrendous, and obviously now you're seeing like, because we're like so levered and we're so in deep on this, that like policymakers are completely panicking. And obviously the decisions that they're making today, I think are going to set us up for, I know, obviously a lot of moral hazard, and then like what does the recovery look like, and the social repercussions.
What do you think a lot of those things are going to look like? Like what are the major vulnerabilities that you would identify? Like, cause that seemed like a pretty specific thing to say, like especially on the policy side, like how would you, if a client were to ask you, you know, what's your perspective on, I don't know, curb or anything that's going on right now, helicopter money. I know as a landlord, helicopter money has helped me a lot, but beyond that, I haven't really seen any benefit, and I really have no clue what's going
Yeah,
on.
well, yeah, I think the checks. I mean, the checks are probably necessary. Like, let's call it what it is. I think that it is creating some perverse behavior where, like, I'm hearing from some friends and some colleagues and stuff that are saying, like, well, you know, I to be honest, I'm kind of happy that I'm not working. You know, I'm getting my $2,000 a month, and I'm just gonna sit here and kind of play video games and hang out.
Yeah.
And then, like, I heard one story where, like, you know, a business laid off a whole bunch of their employees. He laid off too many of them and realized he needed to hire one in the back, and he tried to hire this, you know, one of his employees back.
The guy said no.
I was like, well, he's like, I'm going to make more, you know, with this $2,000 a month free check than I would working for you.
Yeah.
You know, so he's like, why would I? So yeah, I think we're kind of getting down this path of like universal basic income.
Right.
You know, bailouts of, you know, junk garbage companies that shouldn't be bailed out. It's kind of, yeah, you don't really have like the free markets, and it's kind of like, where do you draw the line, right? I mean, if we're deferring mortgages for people that have, you know, 3 or 4 properties, like, where do you draw the line? Is it, should you defer 10 properties? Should you defer 20, 30? Like, where do you draw that line?
It is funny too, because I almost feel like they're just, especially on the deferrals, it seems like they're rewarding financial stupidity. Like, I didn't get a deferral on either of my rentals because I had cash in the bank. They were like, we can see the cash, you can pay the mortgage for 3 months. And I'm like, okay, well, all right, I guess that sucks. I'm financially responsible, so now I have to bear that burden for the tenants that aren't paying me. And then I've heard of people who, you know, just, they didn't have the money to cover the mortgage, so now the banks are like, yeah, do it. I guess do you think that they're trying to, I don't know, create loyalty, like, and kind of keep these people as customers because they don't have to get them back after, or like, what is the, I don't know. I'm trying to
Yeah, I mean,
figure
I
that
think
whole
part of
thing
it
out.
too is, yeah, it's kind of like, I mean, they're all kind of working together too. I think it's in banks' interest. Like, obviously, their collateral is the house, right? So I think that obviously they don't want to see a wave of foreclosures hit the market, because that's the bank's own collateral.
Yeah.
So
Well, it screws up their balance sheet like crazy too, right?
yeah, if everybody's rushed into the market with foreclosures, and you flood the market with foreclosures, and, you know, you're just destroying the banks, basically their equity, their capital. So yeah, I think they're kind of doing that effort to try to keep things up, and that's why, like, I don't know, I'm obviously fairly bearish and pessimistic on the market, but I'm not like doomsday scenario where, you know, this thing gets cut in half. Just because I think, like, at the end of the day, you can see like the amount of massive intervention from all levels of policymakers, whether that's the Bank of Canada, CMHC, or the big 6 banks working together to basically let's call it what it is, defer foreclosures.
Right.
They're all working in tandem to basically help put a floor under it, because obviously if there was no real intervention or minimal intervention, like, obviously we know that prices would probably already be down.
Yeah, for sure.
And they'd probably be falling a lot faster, right?
Are we just like kicking the can further down the road by doing that though, especially with the deferral side? Like, is this just going to create a problem in 6 months when everybody has to go back to normal and still doesn't have their jobs, or like?
Yeah, I mean, I think it's going to mitigate a lot of foreclosures, but I think it's not going to prevent them, obviously. Like, so we're still going to see a spike and probably a fairly large jump in foreclosure sales. But I think that it would probably be a lot worse if you didn't give people that 3 to 6 months to get back up on their feet and get a job and get paying again.
Right.
So yeah, it should help put a floor under the decline. But yeah, I definitely think that it's not going to. At the end of the day, you can't force. I mean, like, you can't force businesses to rehire people, and that's. No. I think the unemployment rate, unfortunately, is probably going to be fairly high for the next 12 months.
Yeah. Even like the sites that I was viewing today, both had retail tenants, and we had a conversation with one of the retail tenants, and they were saying, like, like, I guess they're down to 30% of their sales, and it's sole proprietor, owner occupied, or owner run business, and they just don't like. We were like, do you want to stay on as a tenant, right? Because it's going to take this guy, I guess, 3 to 6 months minimum to get entitlements on the property to move it forward with development, and even that's kind of unpredictable because we don't know if municipalities are even going to be running at full steam. So, and she was like, I honestly have no idea if I'm going to be able to pay pay my rent next month, much less like, for the rest of the year. Like, it really isn't up to me. It's up to all of the people who buy my product. And so far they've disappeared by 70%. So
yeah. No, it's hard to make, obviously it's hard to make business decisions in this environment because you don't know what that recovery looks like, right? Maybe you sort of get back to somewhat normal life in the summer, and then maybe that second wave comes through again, and then you have to kind of go back into quarantine sort of thing. And
yeah.
I mean, I think as a restaurant, I mean, especially in that space, in the hospitality space, to me, that's just like, I don't know how you recover from that. Like if you're a restaurant, you've been shut down now for whatever, 4 to 6 weeks. You kind of come out of it, you come back, you're probably going to be at like half capacity.
Yeah.
And then maybe you get shut down again for another month. Like, I just don't see, I don't know. I think even like very successful restaurants and stuff like that, I think they're going to be going under and probably never reopening.
Right. Yeah. Yeah. I mean, they're running tight margins to begin with, right? I mean, if there's one thing I'll say about the hospitality space, like those are extremely resilient people. So like, it wouldn't surprise me if a lot of them did come back, or it was resurrected well, but I agree with you. I think we'll see some serious, meaningful shutdowns. I mean,
yeah. And then I think as a business, you just like, you kind of look at your bottom line, see where the revenues come in at, and then slowly start to rehire people. So I just don't see like obviously not everyone's going to be getting their job back. And then, even if you get rehired, like let's say you go to a different job, like maybe you're making $100,000 a year and like you don't get rehired. So you're looking around and obviously like it's just, at the end of the day, it's supply and demand. So the companies are not really incentivized to be offering juicy wages at this point. So maybe you go from $100,000 and you get rehired somewhere, and maybe now you're making 85.
Yeah.
I mean, that's $15,000 difference per year. I mean, that's a pretty big difference for a lot of people that are living, kind of with very little savings.
Well, for sure, yeah, especially with like the costing that the debt service ratios of a lot of these people, and especially in the GTA. So on the housing side, like on your sales, how's the sentiment on the buy side and on the sell side? Like you had mentioned prior to us kind of starting the recording that if people need to, like if people see a listing on the market right now, they're assuming that person really needs to sell. And I would say the same, other than like the properties that were kind of listed, a month ago and just haven't really adapted yet or just left it up because of whatever. But what seems to be like the general sentiment on the res acquisition sales?
Yeah, I mean, I think buyers are kind of pretty hesitant right now, so that everyone's just kind of wait and see. And even if you do want to pull the trigger, right? It's like, you might, like, financing is so tight now.
Yeah. So
as a bank, they're kind of like vetting the sustainability of your employment, right? So even though you might be employed today, the banks are going to say, well, are you going to be employed in 6 weeks? We don't know. So financing is becoming obviously a lot more tight. So I think the buyers are kind of most of the buyers right now are just sort of on the sidelines. And then for sellers, if you still have a good product, it will move, especially if it's priced like appropriately. But I think for the most part, we're starting to see like a little bit of price discounting, a little bit of, if you're motivated and you need your cash, like, if you were worth 700 before the virus and you need the cash, like maybe it's worth taking that offer at 675.
Mm-hmm.
I mean, there's an opportunity cost, I think, just having liquid cash in this environment when obviously, whether there's opportunities in the real estate market or the stock market or whatever, there's I think most things today are being discounted.
Yeah, I think you're actually like really. I always when I was studying economics, I always found that a lot of these things didn't apply. But you're really starting to see like a real life example of the liquidity preference, especially in the real estate space right now. Like people are accessing less and less equity just because, again, like they don't. It's the only way to build a hedge, really. Like I spoke with a developer the other day who, like, he was, we call it, like, me and all my buddies call it team never sell, like these guys who just will hold things no matter what, because we want the asset. But the guy liquidated 3 properties to fund project because you have to, have to go after the opportunity that makes the most sense, right? And I don't know. It is interesting to see that kind of at scale in the residential space. Are you like, I guess Van, it looked like was kind of coming down to a more normal level and rebounding a little bit. Like Toronto is just completely out of control, and it's still like I'm still hearing about multiple offers sight unseen on condos because the condo building won't allow showings, but you can still list it on the MLS, and then just people will just offer on it from like a 360 video or whatever, get the status certificate. You don't need an inspection because it's a condo. And then is it like it in Vancouver, is it less out of control?
Yeah, dude, first of all, that's nuts.
It's
But
bananas.
yeah, I just can't fathom why anyone like in the right mind would be in multiple offers in today's environment. But like, again, I can't speak on terms of Toronto. That kind of reminds me of like the pre-stress test. Like my favorite line was like, hey, there's a mortgage stress test coming in effective January 1st, 2018. And so you saw all these people like rushing into the market in to the end of 2017. You're like, you realize that they're going to be choking off credit for everybody. Like logically, that doesn't really make any sense. But anyways, Vancouver was, I mean, it came off like a little bit for about, 9 or 10 months. The luxury market though has been depressed here for probably 2 years, with values down as much as 30-35%. But the low end mid range of the market was still pretty high. There just wasn't a whole lot of supply. Like I said, I think a big driver for that is like when you have interest rates as low as they were, and you have like record low unemployment, like there's just a fundamental demand there for housing.
Yeah.
So that was like our market was like our low. I would call it like our local income earner market was like red hot heading into this before the virus. Again, everybody's got a job. Everyone's recently had a pay raise.
Yeah.
Everyone's feeling pretty good about the economic outlook. Interest rates are low. Housing's been shown to be a resilient asset class over the last 15, 20 years. And so, we're seeing obviously a lot of multiple offers. That's kind of the mindset, and that logically makes sense. But yeah, obviously it's going to be interesting to see once it flips on the outside when a lot of people don't have jobs. Everyone's pessimistic. Credit is tight. And maybe housing is declining and people are like, well, maybe I should wait.
Right. Yeah. I think I'm seeing a lot of that wait and see mentality, even among people who were extremely bullish, like, a week ago, 2 weeks ago. What do you think that looks like in like the short term and the long term then? Like how, like, and you mentioned your personal bearishness, but and you don't want to be doomsday-ish obviously, but like what would a worst case scenario look like? Like does it look like does it look like 87 to 95 or and then what is a like even if you use it as like a DCF almost, like best case, worst case, and then base case, what's the middle? What's sort of like the most likely scenario? I know neither of us are really exceptionally qualified to answer this stuff, but like even just explore scenarios on that. I think that's kind of price decline, volume, like foreclosures. Cause like here, like, I don't know how it is out there, but like you kind of get the soft power sale and then you get like the power sale. It takes a long time for for the bank to want to, cause they really don't want those things on their books, right? Cause it changes how much they can, I guess, lend out or whatever. I was trying to get a grasp for it when I was speaking with Dimitri from RBC, but I guess it changes how much credit they can put out if they take those assets back. So I don't know I don't know how much fire sailing we're going to see. Is it going to be like a slow decline or?
It's hard to say. I don't know. I have like my best guess is like, that's the thing is like, I love like when, you read social media comments or whatever, I always get, all these comments and like everybody seems to know that exactly what's going to happen, how much prices are going to decline, when they're going to stop declining. I'll be the first to admit I have no idea. I have a couple suspicions, and like at the end of the day, all I can do is like tell you exactly what's happening right now. I can give you kind of an outlook for the next couple months, right? Or after that. So my personal view is like I don't know. I feel like in Vancouver, anyways, I can't speak for Toronto. My view in Vancouver is like best case scenario is like prices stay flat, maybe they decline a couple percent.
Yeah.
That's kind of my best case scenario. My worst case scenario is like, I would probably say my worst case scenario is like a 30% decline across the board.
Right.
Which
that's even on like that would even be on like that entry level
like,
product.
So, yeah, I'd be like on condos. Now, I'm not saying I'm personally predicting 30% because I'm not that bearish. I know there's guys like, well, because like fundamentals and because of like price to incomes, it should drop, 45, 50%. That would be like fair.
Right.
But I think what people are not qualifying is literally how much intervention there is from policymakers.
Right.
That it's not a free market. It's not going back to what it was.
No.
It's not going back. It's just the sad reality. It's a manipulated market.
Yeah.
Between OSFI, CMHC, the Bank of Canada. I mean, look, the Bank of Canada is engaging in, I mean, they don't want to call it quantitative easing, but this is massive QE money printing.
Yeah.
Where they're basically trying to devalue the currency and prop up asset prices to help mitigate the fallout from the virus. So that's just the reality of what it is. Now they can print as much as they want. At the end of the day, they're not going to be able to get people their jobs back. It will help, but I still think prices are going to drop. My personal view is like in Vancouver, I could see prices dropping 10% in the next 6 or 7 months just because there's no liquidity.
Yeah.
If you need to sell, you're going to have to sell at a discount. I don't know if I had to guess, my view price declines, maybe I see like a 20% peak to trough across the board.
Right.
And that could take a year. It could take 18 months.
Yeah. I think it almost is more quantifiable in Toronto because I don't know if you guys had this phenomenon in Van so much, but like where you could see, you'd have a building that you could get a resale in it for $1,000 a foot, and there's a pre-con rate beside it going up at 1,200 or 1,300 a foot. And I think it's pretty clear to everyone at this point that whole any of those projects that are closing within the next, let's say, 365 days are that premium is kind of wiped out. Like the froth is gone.
But, yeah, which makes it tough, I think, for a lot of these people to close too, right? Like right. I see it here in Vancouver. Some of these people paid like significant premiums for these pre-sales on the belief and expectation that when they close, the prices would continue to be up and rising.
Yeah.
But now, like, obviously they're not rising, they're flat, and they're probably going to be declining by the time they close. So it's going to create some issues with people getting financing to close on these pre-sale, especially if they don't have jobs. And so yeah, I think that's probably one of the risks in the market here.
Or even wanting to close. Like I'm wondering if, like let's use one of those as an example and say, okay, especially because they were getting more and more lenient with the deposit structure. So it's like, if you were buying a condo pre-construction and overpaying for it by 30%, hoping that was priced in and it's anticipated to close, you just stop paying your deposits or walk from the deal. And now, so who's the vulnerable one there? Is it because those deposits are insured in order for the developer to lever them to get the project going? So is it your I can't remember who insures the deposits now, but is it the insurer? Is it the bank that is it whoever holds the debt on the?
So I don't know how you guys do it in Toronto. I think it might be slightly different, but yeah, in like Vancouver, you put down your deposit. If you walk away from the deposit, the developer is going to keep the deposit and then probably sue you for the difference. Obviously, if like a huge chunk of buyers walk away, it's going to be probably hard financially for the developer to sue a whole bunch of people.
Yeah.
Because they might just be bankrupt by the time that happens anyway, so it won't really matter. But so as the buyer, you can walk away and lose your deposit, potentially get sued for the difference. Obviously, if it becomes systemic, like too many people walk away, and then that could be, and you're whatever midway through construction, that probably leaves the lender on the hook, which was kind of what you saw like in the US in 2008. Like the most vulnerable projects aren't the ones that are about to pre-sell. The most vulnerable projects are the ones that where the developer thought that 80% of the building was pre-sold, but 20% of those buyers walked away, and now you're left with 60% of the units unsold, or 40% of the units unsold. and you're 3/4 of the way through construction or half the way through construction.
Yeah.
Trying to get another draw from the bank, right?
Yeah, no, that's one of the big fears from my perspective. Like, I think it's easy to see where things could come down from like in the resale market, but the pre-con that's like built in speculation, right? That I don't know, like that to me is the biggest vulnerability. Like, I think you're already seeing it with discounting, like you're describing in Vancouver, but
well, it's just like a pre-sale contract. It's just a futures option.
Exactly. And
oh, it is.
Yeah. And but in the resale market, I think, like, if the resale market's declining as well, like even if, let's say, the growth is gone, like you no longer believe that the speculation is there, if it's in a declining price environment, like that asset's now running away from you, right? So, like, and we've seen some, like a lot of these guys, and I don't know, and maybe because you mentioned, your like your sort of your domestic purchaser, your local wage earner is sort of the one who seems to be at least relatively prominent in the market. In Toronto, it's not like that at all. Like, the people who are earning wages in the city, I'd say, especially in condos, are renting them from a speculative investor. And a lot of these guys are doing it for Airbnb, or were buying for Airbnb pre-regulation. So now you have these ghost hotels that are vacant. So that was tranche number one that fell out. Like, and you're starting to see those. I know people who literally have said, my entire building is empty, and you can go and see like hundreds of units for sale. And I mean, I'm probably speaking hyperbolically here because I'm not super in touch with it, but you know, there's a handful of units for sale in a building, and that building's not even allowing showings, right? The condo corp isn't allowing showings. So that would be, let's say, tranche one. Tranche two would probably be, to me, negative cap rate rental condos, which is, I'm going to say, the majority of stuff purchased pre-construction within the last 3 years. Like, those people aren't cash positive unless they're basically like 80 to 90% equity. Is there like identifiable like risk categories in the Vancouver market like that? Or are you guys a little bit more stable? Because like those are the big vulnerabilities from my perspective in Toronto.
Yeah, I think there's a lot of like negative cash flowing condos, and yeah, there's definitely a lot of that. I don't know. I think people aren't really quantifying, like, I don't think people are quantifying like the rental market. So I think there's a lot of like misnomers in the rental space, like that. Oh, well, when house prices fall, like in a recession, that rents will go up, but
Right.
it's not at all the case. Like this is like a massively deflationary environment. I can't think of like a more deflationary environment, like a 15 or 20% unemployment rate. Like,
Right.
This is so deflationary. Like you can see it, like everyone's cutting their price. Like if you want to go like pick up food like down the street, like they'll do takeout, but it's like, we'll do takeout at 20-25% off.
Right.
Everyone's just trying to generate like some source of income. Like, and so same thing for rents, right? You talk about like the people that are renting out all their Airbnbs, all of a sudden they're not making any money. So they're like, well, I just kind of rent this out on the rental market. Obviously right now it's more difficult trying to find a tenant. And so if you have like 10 identical units in a building, like it's kind of like the first guy to lower the price is probably gonna get the tenant.
Yeah, for sure.
So I think that's just deflationary. And then obviously when you have a high unemployment rate, like you can't leverage up your rent. Like if you don't have a job, like, and if you're not getting a raise. So yeah, I'm seeing like in Vancouver, like the rents are actually starting to come off a little bit. I mean, they peaked out about 15, 16 months ago, roughly. Right. About a year and a half ago, realistically.
Yeah.
But they're actually starting to come off a little bit. So that kind of makes me a little bit nervous, right? Like, if you're a cash flow negative, whatever, $300 a month, and your tenant leaves, then you got to fill them at a slightly lower rental rate. Now you're cash flow negative $400 a month.
Right.
And not only that, but your values are down 10%. Like, at what point do you just go, oh my God, like it's just not worth it anymore?
Right. Yeah. And then also, I mean, I guess there's the looming risk of an increased vacancy rate. Cause like, I mean, if unemployment stays down, the sort of function of a central business district kind of disappears. And a lot, like, I know just a lot of people from my generation who moved to the city to work, and they work in like hospitality or whatever. Some, like entry level, or like, kind of starting their career. And if they're laid off, like they're most likely going to go back to live with mom and dad to protect the costs. Like, and a lot of these people, their parents were helping them pay rent in the city anyway.
Yeah. I think that's the thing, right? Is people I mean, yeah, I think the same thing. Like, I worry a little bit in Toronto is like your guys' you guys had a massive inflow of immigration. Like, you can see it in the data, but like, I don't think people quantify that. Like, those, like, a lot of that immigration like turns into like actually net outflows, and you get a deep recession.
Right.
Like, saw that in 2008, and a lot of these, like, I think Spain had immigration growth at one point was growing like 5%.
Right.
And it actually turned into like a net outflow, because like when jobs dry up, like, well, there's no point coming over. Like,
Right.
why
No
would you?
incentive. Yeah. Actually, it's so interesting that you say that, because I have one of the bigger investors that I worked with locally, Sri Lankan guy, just said, I'm just going to leave. I'm just selling everything and leaving. Like, I might as well. And that was prior to this, right? Like, and now he can't leave because he can't fly home, but he was planning, basically he was planning to move everything over the course of this year, towards the end of last year and this year, and go back to Sri Lanka and retire happy with a lot of dough, where his money buys a lot more. Like, the incentive for people to relocate here, it's we're our competitive advantage as like the greatest place in the world to live or move or buy housing is decreasing, which is exceptionally scary. Right?
Yeah. So my view on that is, like, from a longer term perspective, like, we're always going to be immigration friendly. Like, that's like our model of growth essentially.
Yeah.
It's like, especially like low birth rates. Like, that's what we do in Canada. We just immigrate people. But like, that's not to say the next like 12 to 24 months, when you're in a weak economy with weak job prospects, that you can't see very little growth of immigration and
Right.
population growth. So that's just like a headwind, because you have to think about all the developers in, say, Toronto, that have made decisions based on recent performance,
Mm-hmm.
based on the recent growth of population and people moving here, and business growth and wage growth. These are all kind of baked into like their pro formas essentially, and those are obviously going to get eviscerated.
All those assumptions are now wrong.
Yeah, there's all these assumptions. Everybody just basically extrapolates recent performance, right? And yeah, I think it's a slippery slope.
For sure. Yeah, that does worry me. Like, I don't know how long it takes for us to recover, almost like on a national level, as like the place that everybody globally wants to go move, because we have the stability, low crime, British Imperial Land Registry system, like, and I guess I would just assume that migration globally is going to decline for at least for the foreseeable future. And if that's our core competency as a domestic economy, and a big portion of our GDP, that's worrisome as well, right?
Yeah, I just think Canada is going to be a bit of a tough ride. I think that just the way that it's built, it wasn't really designed. Like, I mean, first of all, you were coming into this with like a record level of household indebtedness.
Yeah.
That shock to the consumer is going to be massive. I mean, the consumer is roughly 65% of GDP, so that's going to be a huge strain. Like, the record high household debt servicing ratio coming into this, the U.S. was at record lows because they took the pain in 2008. So your consumer, and the consumer had, I think, a near record low savings rate dating back to 1960. So there was no buffer there for these households to absorb this shock. That's number one. Number two is obviously like what's happening in the oil market. I mean, it's getting eviscerated. That's a huge, decent chunk of our GDP. So that's like another headwind there. And the third headwind would be sort of that immigration flows. That was something that we were dependent on. That's going to slow. And then obviously if housing slows, which it looks like it's probably going to, I mean, there's not a whole lot of, I mean, I think that David Rosenberg called the Canadian economy, right? I think he summed it best as the triple C's: condos, crude, and cannabis.
Yeah.
And so, I mean, all three of those industries don't look very good right now.
No, you're right. So what does that mean, that we're going to end up worse off than probably like our global counterparts, or?
Yeah, I just think it's going to be a tough recovery for Canada. I think
I would agree with that.
like, I think it's going to be a tough recovery for a lot of places, but like, I mean, like everybody, the obvious ones for me coming into this are like Canada and Australia, just because of like the massive amounts of leverage in the household sector that never delevered, the massive growth that's been derived off of housing. and obviously a lot of it over the last couple of years particularly has been dependent on like China and foreign investment and commodity rich countries that commodity prices have been just getting smacked around. So yeah, I think that coming into this, those are the two most obvious, and you can kind of see it in the currencies. I mean, Australian dollars getting just destroyed this year, and Canadian dollars down. I mean, last I checked, is down about 8% right now. So
what remaining vulnerability? I mean, I think we've been pretty exhaustive about kind of like what it looks like. Is there any remaining vulnerabilities that we haven't really discussed that you see that you want to throw in there?
Not really. I think it's just the feedback loops, just to sort of see like how this works out, right? And obviously, like if the housing market starts to slow, which again I think is likely, how much the prices start declining, then you're shutting off the new housing starts will basically come to a grinding halt, permits, etc. And that just, when you're 25% of your GDP is in real estate finance and insurance, it's such a huge driver. Like, I mean, look at Toronto. Like, you guys have massive, new home construction. I think you guys have the most cranes in North America. So like if that sector slows, like logically as a developer, I would be looking at this and saying, okay, like maybe we should just slow or delay new projects. So that alone like can sort of compound and feed into like the recovery of the economy. And like I can speak for Vancouver, like right now we have a record number of new homes under construction, like by a long shot. And I suspect housing starts are going to fall off. So that's going to result in more developers laying off their contractors and less work. And basically at the end of the day, it's less credit creation because of, credit's created basically through new mortgage issuance.
So that feedback loop.
Yeah, it's just a feedback loop. And obviously, like I said, I think policymakers are going to do everything they can. Whether you agree with the actions that they're taking or going to take, the reality is they're going to take them because they don't really have a choice.
There was a couple of trends like that I saw kind of earlier this year and even late last year where I think people started to acknowledge in the Toronto market, especially that, that the credit scenario is getting alarming enough that it was worth building a little bit of a hedge on a lot of these projects. So a lot of the really, really sharp developers that I was working with, and obviously CMHC played a big role in this, but that purpose-built rental development program that they were putting into place, and sort of, I mean, like on their website, they're saying something like 90% load to cost on some of these projects for developers and stuff. We were getting guys, I remember at the Avina office who would basically just pay, let's say 10 grand to get to have that in their back pocket, right? So we'd get them an approval so that they could pivot if something like this did happen. Or, I mean, they weren't even anticipating, like nobody, you can't really forecast for a black swan, but if we kind of hit the wall, right? And so I think some of those might be okay. I'm wondering if this just ends up kind of and creating a feedback loop, like similarly to what you described, where all these guys or a lot of them are pivoting to purpose-built rental with the support of CMHC to keep everything going, and therefore kind of just pulling more and more potential earnings out of the pockets of a lot of these speculative condo investors. And if it ends up being all of a lot of that foreign capital that took the risk on the Toronto market, 2 years ago or a year ago, it looked like basically China was just doing wealth creation for Canadians by increasing our asset values. And now it looks like they might just be the ones taking the hit as well for us. I don't know. I mean, if it like,
I
don't know.
Yeah, there's a lot of, you have again, in Vancouver, you'll basically have record completions probably this year and next year. So it's like you're adding like basically a record amount of like new supply is going to be completing at a time when probably the market's going to be quite soft. So it seems like all you have to do is like study past real estate cycles. It seems like the supply always ends up coming on at the worst possible time. Just because like there's such a lag, and then it's like eventually it comes.
Right.
And it comes like when the market is like kind of down, it kind of adds to the pressures. And then obviously like you'll eventually restart your next real estate cycle. Once the housing starts to fall off, and then there becomes a shortage again, and then that sort of cycle starts again. But I'm personally been like pre-virus, like I've been banging my fists on the table for the last couple years is that like I'm super bullish on like developers going into the rental market.
Yeah, same.
I think secularly, all you have to do is like look at the U.S. Like the home ownership rate never really recovered after the financial crisis.
Right.
And I think from a secular standpoint, I think that the highs are in for Canadian home ownership,
right.
particularly with the prices where they're at. And I think that maybe this will make people more adverse to taking on massive amount of debt.
Yeah.
Having to go through like this huge shock and pain, like maybe that will change some of their habits, and maybe they'll be like, maybe I don't want to take on $1 million mortgage. Maybe I should go rent.
Yeah.
A purpose-built rental building, and
with a landlord who knows what they're doing. I've always thought about it that way too, but more from the European housing perspective. Like I'm half Swiss, so I spent a lot of time there. I did my military conscription in Switzerland, and homeownership's really low there, and people are happy, right? They make their money elsewhere, and real estate as an asset class is very inaccessible to most people. Like Switzerland, it would be the most inaccessible economy for most people to purchase a property in, and nobody has an issue with it. And I think Canadians just are so wrapped up in that dream, right? And maybe this is the end of it. I don't know.
Yeah, I think Germany's like that too. The Germany home rates like what, 40%?
Yeah. And like, and you get incredible rental programs there because like everything's managed well, right? Like, and there's proper legislation in place, and I mean, here it's like
very like landlord. It's very renter friendly.
Yeah. Well, I mean, it's supposed to be renter friendly here, but like you also have so many. There's people trying to exploit the system from either side, and at least in the Ontario Landlord and Tenant Board, it's just like it's a gong show.
I actually think so. Again, like I just think based on like where everything is going, it's just like my bigger picture view, and could very well be wrong, but I think bigger picture view, we've already seen it over the last couple of years, but like bigger picture view, I think it's going to continue. More and more government policies are going to be forced to favor the renter.
Yeah.
And regardless, like whether you agree with it or not, like you're going to see more like caps on rental increases.
Yeah.
Caps on being able to evict people. Like I think it was like Berlin, like in Berlin, they did a 5-year rent freeze.
Yeah.
Like across the country. Like,
yeah. And at that point, then you only really have, institutions who are able to have that much risk on their books, right? Like you're not going to get the speculative investor who comes in here and thinks they're going to be, buying at a 2% cap rate, but the unit's going to go up 10, 20%, whatever. Like, I think that, I don't know, it is kind of, Toronto is especially bad for it. Like I know people who have never spoken to their landlord ever. Right. And like, I don't know. I'm like, a lot of my buddies call me a slumlord. So I do like a lot of like kind of like rural GTA stuff, which is exceptionally funny right now because all of my tenants were already on EI or OW or ODSP. So like they already had their money while all my luxury rental friends their tenants are waiting for theirs. Right. So I thought that was kind of funny. I want to be mindful of your time. One of the things that I really like about like watching a lot of your videos is like you kind of inject like just these little bits of wisdom of just, I don't know, just really, you say it really like well. What kind of advice are you giving to clients, to people that follow you on social media, and like how are you advising people right now to deal with this? And then if you want to even comparatively discuss what you're doing on an individual level to kind of deal with it.
Yeah. So I don't know, the clients, I usually I try not to give blanket advice. I usually try but I would say like as a general rule of thumb, like I think now is the time to kind of hedge your risks, like your downsides. Like, if you got 3 rental properties, like maybe you should sell one of them if you need the cash.
Right.
If you're losing a bunch of money on them, like maybe you sell one. Like I don't think you need to sell the farm. Like I'm getting like random emails from people like, hey, I just bought this pre-sale, I'm supposed to close, should I just walk away? Like, no, I don't think you should walk away. Like we don't know what the market's going to do. Obviously I do believe that prices will drop. Does it mean that you should just walk away from your commitment? No, I don't think that is just the case. But I think for buyers from the sidelines, I think time's going to be on your side. I think over the next, in my view, 6 to 12 months, I think there's going to be some good opportunities. Again, could be wrong. Maybe prices just kind of stay flat, but I don't see what the point of is like rushing right now to like compete in multiple offers as the unemployment, as in March, 1 million Canadians were laid off, and like the numbers obviously way higher. I think, you know, the Bank of Canada can't even put out a GDP forecast for Q2.
Right.
So they had no idea. It's the first time they haven't put together their monetary policy report. So they're saying, all we know is that we're giving you GDP will decline between 15 to 30% in Q2.
Right.
They don't even know. That's like
a money back guarantee on that.
Yeah, these guys are flying completely blind. They're telling you it's going to be so bad that they can't even make a prediction. But it's going to be between 15 to 30%, which is the worst that we've ever seen. And you're running out to compete in multiple offers. To me, that's like absolutely crazy. But again, like obviously teach their own.
Yeah.
So that's like that's my view personally. So for me, I'm just like sitting on a lot of cash, buying up, buying a little bit of stock here and there.
You doing any bear ETFs?
What do you mean by bear ETFs?
Like SQQQ or like SPXS or anything like that.
Oh, are those like inverse?
Yeah.
No. I don't play around with that dynamite, man. No, I'll usually go like I don't know, I don't know, if I'm doing anything, I might do like, if I'm optimistic on something, I'll do like a long call. I'll do a little bit of put options as well.
Right. It's tough though, man. Like, what the hell is the market even doing? Like, it just defies logic, right? Like, I guess there's that
so much volatility. Yeah, man. There's so much volatility. I think this is like a pretty big bear market rally. But again, like I don't know, so this is the thing. Is like I don't know what's gonna happen.
Yeah.
I'll be the first to admit that, as I said earlier. But like, it's funny because like I'm taking a lot of this spare time right now to like read and watch videos and study like the smartest people in finance. So I'm reading like last couple of days I read like Howard Marks.
Yeah.
I don't know if you know who that is.
No, I don't, but
so Howard Marks, he's wrote the book on like mastering the market cycle. So he owns like a massive credit fund.
Yeah.
So like he's basically like the king of like every time shit hits the fan, Howard Marks is coming in with I think right now he's trying to raise 15 billion.
Nice.
To purchase distressed assets. So like this guy is like the king of like cleaning up distressed assets. And then you got like Ray Dalio, who runs Bridgewater, one of the largest institutions.
I follow Dalio religiously.
Yeah, so I was watching like Dalio's Bloomberg interview today, and like, he's just like, listen, like the economy's not going to recover for some time, but that's not to say financial assets are not going to recover. He's like, the amount of currency debasement that's happening right now is they're basically trying. I mean, the Fed's buying up, junk bonds. Like, how do you fight that? And so same thing with like Howard Marks. Howard Marks is like, hey, listen, like we're buying a little bit right now. We're not like deploying all of our cash. We're sitting on a huge cash pile, but like we're slowly deploying it because a lot of these assets are down 25, 30, 40%. So that's kind of my view is like, just like you can't, at the end of the day, even though stocks would or should fall further, or real estate would or should fall further, at the end of the day, it's like it's hard to fight the central banks when they literally have come out and said there's unlimited amounts of money we're willing to print, and
they're basically just like at this point indirectly buying equities too, right? Like I think through ETFs and shit like that in the US, or that's the plan. I'm not sure.
Yeah. There's like they're buying like junk ETF bonds essentially. Like,
so at what point does that become like? Do we enter into an inflationary environment like where we're at risk of ending up like the Weimar Republic? Like, is it because people aren't out spending that money? So I guess and then also I'm assuming the assumption is that all of that money is being concentrated into the hands of few. So it's not like, is it not because trickle downs doesn't work? It functionally won't create an inflation. Is that their hope?
Yeah, I think that one's like a tough one. I personally, my view personally is like, I think this current environment is obviously deflationary. I think it's going to be deflationary for the next, whatever, 1 or 2 years. But I think at some point, like the inflation is going to be rampant. It's going to get away. Like, like I don't know, like there's people that are smarter than me that are kind of saying like essentially like the Fed is essentially merged with the Treasury.
Right.
And it's a very slippery slope when you start monetizing all these debts and like, cutting checks to every citizen. I mean, we're almost basically at a universal basic income at this point.
Right.
So yeah, I think at some point you're going to see inflation, and it's probably, I think it could, it could be one of those scenarios where it gets out of control. Like you go down that MMT route.
Yeah.
And then, then all bets are off, and it's a different environment, and you
Yeah.
gotta try to.
Yeah. Then you get to cash out all your positions with money that's worth half of what it was when you bought them, right?
Yeah. So yeah, I think you just continue to like reposition. Like you just got to keep watching markets and see how things progress. But yeah, you can't predict it. Like real estate might be a bad investment for the next 12 months, and then it could be a good investment again for the next, 5 or 10 years. If you get, significant inflation, that's a good inflation hedge.
Yeah. Okay. Is there anything else you want to add or discuss that we didn't really get into? I think you.
No, man. I think it was pretty good. It was a good conversation.
Yeah,
A little back and forth.
Yeah, no, I really enjoyed that. Where can people find you if they want to connect? Like, where do you prefer they follow you or send you an email or whatever?
Best way to reach out to me is by email. So just Steve at stevesaretsky.com. Or if you can follow me on Twitter, that's where I'm most active, which is just at Steve Saretsky.
Awesome. Okay. Thanks a lot, man. I really appreciate the insight. I think I've been looking forward to picking your brain for a while, so it's nice to kind of have this black swan here for us to stare at and discuss.
Yeah, man. This was good. This was fun. Hopefully, it brought some value.
Yeah, you definitely did. Thanks again, man. I really appreciate it.
Thanks, man.
Great. Talk soon.
That was good.
Yeah, it was.
Cool, buddy.